anyone joining us for the first time, thanks for coming by and checking out the Market Chameleon pre-market show. How you doing, D?
Hey, Will, how's it going?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. There's the disclaimer.
Excellent.
I am going to share my screen. While I'm doing that, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, type it into that live chat on YouTube. Will's watching it and he'll read them back to me. And what we'll do is take a couple minutes to give you guys a chance to put those questions in, and we will cover the pre-market report, which will give us some insights, what's going on in the pre-market hours, and then we'll move on to the questions. Okay?
Excellent.
So, pre-market report, these are stocks trading in the pre-market hours. And we're going to start out up here. We see a calendar view, and this does allow you to go back in time to a historical date if you wish to see what happened in the pre-market hours historically. We also show up here the last week. This way, we could just eyeball, see if we spot any types of trends or patterns. Right now, we're on February 2nd over here, and we see that so far we have 407 stocks trading higher in the pre-market, 423 stocks trading lower. We have 80.5 million shares trading on up volume, 71 million shares on down volume. If we convert that volume to dollar value, we have $5.8 billion worth of stock trading higher, $2.3 billion worth of stock trading lower. So, from the top level, sort of a mixed bag there. Maybe, if we look at the dollar value of the shares, it looks like that is indicating that the trading in a pre-market is leaning bullish. However, let's take a look from a couple more perspectives, then we'll move on to the questions. So I'm going to now scroll down to the middle of the page. And now we see stock symbols that are trading in the pre-market hours. And we have a list of the most active stocks, the biggest percentage gainers, and the biggest percentage decliners. We do have 74 stocks that made our largest percentage gainers list, 91 on our largest decliners list. So that indicates perhaps a more bearish lean in the pre-market hours. And to make this list, we do set thresholds for liquidity, price, and volume, because things in the pre-market will trade with less liquidity, less volume. So to make this list, if the stock is trading in pre-market hours and it has to meet our thresholds, and it trades in one of the major U.S. exchanges, it could make this list. So it can be a small cap stock. We see the market caps over here. It can be an ETF. It could be a leveraged products. It could be an inverse ETF, a closed-end fund. So to narrow down to a small group of stocks, we could use the filters above this list. And by using this filter, it will recalculate these three lists based on the filter that we choose. If you have a watch list, you could filter by your watch list. So this filter over here in my watch list, you could see if you save the group of symbols that you like to follow, you could filter by that group. We're going to use this filter here in ETF, which is our oh, here we go. Let's click it here. And when you click on that filter, you'll see that there are different ETFs that you could select from. We're going to choose SPY, which is the S&P 500 ETF. And when you do that, the list below will get filtered by this by the stocks that are holdings in the SPY ETF. So these are the S&P 500 constituents. And here we have 8 stocks that made our percentage gainers list, 15 that are on our largest percentage decliners list. So that also points to a slightly bearish lean or bearish bias in the pre-market trade. Okay. So a couple mixed bags there, I guess. We're depending on which perspective you look from, but nothing overwhelmingly points to all very bullish or very bearish. And just keep in mind, we still, I think, have some earnings coming out. So these little E's here, you could see you hover over them. That's indicating that there's a earnings either yesterday after the market closed, could be today prior to the market opens, and the stocks are reacting to those news events. And a couple big ones I see, what Meta reported, that's on the top one, up 16%, almost 17% so far in the pre-market. Looks like Amazon reported up almost 7%. We got Apple, so forth. So, but some big tech companies reporting earnings, and that obviously it's having some impact there.
Yeah, I think this week was all the big tech companies.
Yeah. So I think that we gave it a couple minutes, Will. If we have questions, I'll take them now.
No questions that popped up. I don't know if you want to add to this discussion at all, but Rob mentioned the unemployment number came out today and it was better than expected. And he feels that, and obviously it's throwing a dart at a dartboard, right? With these rate cuts, but everyone is betting on these rate cuts coming sooner rather than later. And it really does look like the economy is chugging along nicely. Is there a rush to cut rates? I don't know. It's interesting though.
Yeah, it looks like a lot of people lined up for this rate cut. I don't know where's the 10-year bond now, below 4, I think, the last time.
Yeah.
The last I looked. Yeah, so far though, the indication is that that the economy is improving. Asset prices are still inflated. Where if you look at the market, real estate market, the stock market, we're trading near highs. Nothing's deflated, right? There's the prices actually seem to be either sitting near the multi-year or all-time highs or ticking higher. So I'm not sure that there's a good case right now to lower interest rates, even if their inflation reading is at 2%. So there's no reason to think that maybe 5.5% is the neutral. We don't know. Like, maybe that is the neutral. Maybe that's where we should be at, and there's no reason to lower. What I think the expectations, if you look at the 10-year, the neutral rate should be much lower, but who knows? It could be 5.5%. That could be like where the rate is not stimulating or contracting. It's a guess, but so far it doesn't feel that there's a good compelling reason to lower rates. Because we're not seeing deflation, and we're not seeing the economy slowing down.
Really doesn't feel that way, that's for sure.
Yeah. So and I think that maybe that they even kind of signaled that a little bit as well. The Fed may have signaled that a little bit. So we'll see if things start to readjust.
Right.
All right, so let's see if there are no questions. Maybe I'll come back to, let's go to SPY for now and wait. Questions come in, I'll take them. But we did leave off, I think on Wednesday, maybe we're going over this activity report, which basically summarizes the options volume for us. Because, when you're trading option, it's not, unlike a stock price, when we were looking at options volume for a particular symbol, we do have all this, we have this consolidated aggregated number volume, right? 9 million contracts. However, we know 9 million option contracts, it's not like 9 million shares of stock, because the contracts themselves can vary. It could be a call, it could be a put, it could be an out of the money strike, it could be an in the money strike, it could be an at the money strike, it could be an option that expires today, it could be an option that expires in a week, or an option expires in a month. And that volume can trade different, right? It could have been a call, or it could have been a call spread, it could have been a butterfly. So when we talk about options volume, there's a lot going on beneath the surface, a lot more. There's a lot beneath the surface, even in stock volume. We talked about breaking that down. However, with options, they're not all the same, right? For sure, they're not all the same. So when we have this volume, we try to start then, bucketing it, categorizing it, so we could keep drilling down and trying to figure out what do we think happened here as far as the option volume goes. And that's what this is, a kind of a start where it starts to break down some of that option volume, and an option actually values or prices. And we talked about over here, this is the breakdown of how much of the volume traded where it was just single leg call or put, right? That's over here. How much traded where these were orders based on multi-leg orders, right? Call spreads, put spreads, they were entered in as multi-legs. How much was it contingent? And then a breakdown call and put. Then we came down here and we said, okay, let's go down further and break it down by expiration. So here we have a list of all these different expirations organized by the shortest dated to the longest dated expirations. Next to the expiration, we have the related data and analytics. We have the at the money implied volatilities, the change that the money for that expiration. So looking at it from the perspective of in a table, we could even sort of eyeball and try to figure out, how the term structure looks like, because that the money IVs are different from one expiration to the next. Then we talked about skew, and we know, so that would be a term structure skew, right? There's a skew when we go out, and I see a couple zeros. I think they're adding probably new months here. So I think these are maybe new months that we don't have any readings for yet. So when we look at the term structure, well, that's a implied volatility skew as we move further in time, right? So the at the money IVs could increase as we move it further in time. They could decrease. They could maybe, the slope could steepen. It could flatten. It doesn't always stay the same, and it's not the same volatility all the time, right? So that's a horizontal skew. If we look within an expiration, inside the expiration, we also have a vertical skew. The skew is that the implied volatilities of the options are going to change as you move from one strike to the other, right? It's not always the same. We know that there are skews in the options, and they could differ. They could sometimes it could be a downward skew, sometimes an upward skew, sometimes a flat skew. And it changes, right? It changes based on the trading, the supply and demand, and the market's outlooks. So what we did was, I think we stopped at the skew here. And just to recap, what is the skew, February 12th? Wait, is that where we stopped, Will, or did I move on to the volume?
No, I think it was the skew is where we stopped.
Was it the skew? Okay.
I'm pretty sure.
So how do we benchmark the skew? How do we measure it? Because if you look at the skew, I mean, you could have 20, 30, 40, 50 different strikes in an expiration, right? And all those strikes could have different implied vols. Here, let's take a look at it. I'm going to go here to the options chain in SPY. And then I think I was looking at February 12th. So here we have the options chain, February 12th expiration. And if we look at the different strikes, we have calls on one side, puts on the other. Well, how do we figure out the implied volatilities? Well, we have an option pricing model. In an option pricing model, you could put in an option price. And then you put in, your interest rate, dividend assumption, right? Days to expiration. It's a methodology, right? It's not this closed formula. It's a methodology. It's an algorithm, and you work backwards to figure out what is the implied volatility of that option. However, even in a call, well, we have two different prices. You have a bid, you have an offer, then you have the puts, you have different strike prices. So now I have implied volatilities all over the place, right? I have here's an entire, right, column of implied volatilities for the bids, for the calls, entire column for the asks. So they're all over. We even here alone. How do we benchmark that skew? Because there's too many numbers there. It's not like a stock price. It's a little bit easier to benchmark. You do a 20-day moving average, right, for a stock, and then compare it to today's. But how do you benchmark a skew? There are too many strikes and they're moving around. You got to kind of have some kind of a methodology, all right, to say, in essence, what do we think is going on? Is the implied volatility increasing as we go up? And is it decrease or increasing as it goes down? Is it increasing or decreasing? And by how much? Okay. So we need some quick way to benchmark it. This way we could observe it and compare it and then move on. Right? Okay, so how are we going to benchmark this skew? Let's go back to the activity. So now what do we do is we have a skew where we normalize it to say the following. What if we took the at the money IV, right? If we took this at the money IV February 12th, and it's 11.3. And if we took 11.3 and we put it into the Black-Scholes model for every option, we don't care what the actual prices are for now. What we want to do is put 11.3, and for every option, we're going to apply that, pretending there's a straight skew, right? Because at the end of the day, really, from now to expiration, there's only going to be one volatility, right? We don't know what it is, though, but it's only going to be one volatility. It doesn't have 10 different volatilities from now to expiration, right? It's like, so we don't know what it is, but let's just say we gave it an 11.3 using the at the monies. And we gave every option 11.3. And then based on that, we found the option to the downside of 25 delta put. And we said, okay, what is the actual market implied volatility of the 25 delta put versus the at the money, right? And we see here it's 6.1% above. In other words, that out of the money put, the implied volatility is higher by 6% relative to that the money. So okay, so the downside skew, it's moving, it's sloping higher, it's moving up. What about as we go up in the strikes from that the money? So now we find the 25 delta call, and then we say, okay, now let's compare. Let's compare the at the money 11.3. Let's compare that implied volatility versus the actual market volatility. And then what do we find? Well, they're different. Well, how much are they different? Well, the 25 delta call is 5.4% below that. Right? So this is how we're benchmarking it. We're saying, okay, now we have kind of an idea of the skew. We know that how it's sloping, right? Which way and which direction it's skewing. We know, it's moving up as we go down in strikes. It's moving down as we go up in strikes. And we know by kind of the magnitude of that skew, right? It would be different if this was 1% and this was 1%, or this is 6% and 5%. So now we kind of have an idea in our mind what this skew kind of looks like, right? We don't know every single strike. I don't know like the 10 delta or whatever, but I have some kind of a benchmark, an idea, how it's looking. And then I could just even compare it to how this looks as we go out further in time. As we go out further in time, we see that the skew itself, it increases, right? That it steepens that slope. It's a larger slope. It doesn't flatten, it steepens. So just like we're going out in time, and the implied volatility is also increasing. And if we click on it, February 12th, if we click on these are clickable. If we click on it, it'll show you a graph of that implied volatility. So we have two lines here. We have a red line and a blue line, right? And what that does is it tells us how the implied volatility skew, how that vertical implied volatility line changed from one day to the next. Okay, so this red line, right, tells us where the implied volatility was the day before, and the blue line's telling us where the implied volatility is currently. So we could kind of see, this is how the line shifted. So how did the line shift? Okay, so here we have the red, and here we have the blue line, right? And we're comparing the two of them. So we know the blue line is the most recent. The red line is the day before, right? And we're trying to get a sense of, well, what happened here? So this is what happened. And this is the at the money. So currently, you see this where it says current, that would be where the stock is right now. So that's where you would say that, at the monies are. So what can we tell from what happened? Well, the blue line, as we go up in strikes, right? From the time we start from the money, and as we go up in strikes, it looks like that the implied volatility is decreased from the prior day, meaning that there's pressure on the option premiums, around the money strikes and the strikes going higher. People might be buy writing, people might be selling options, so they feel more confident, or they said that some of the uncertainty went away. Maybe more earnings came out. Some of the uncertainties to those upsides seem to be going away. The markets are implying that the upside moves will be more orderly or organized, not as volatile, right? So that's one observation that we're making from the line. However, even as that happened, right, even though as we see that happened, the entire line did not shift lower proportionally, right? So if you look at that line, look what's happening as we go down in strikes. As we go down in strikes, those downside implied volatilities ticked higher. So it's not like the whole blue line just shifted lower, meaning proportionally, implied volatility just came down across the board in the lower strikes and the higher strikes. That's not what happened. That's what we're seeing here. We're like, oh, wait a second. Even though there was demand coming in, it looks like to sell options, right, around the monies, and that there's perhaps some protection, buying as well to the downside. So what happened here was that the line kind of rotated, right? It didn't shift completely up or down. It kind of pivoted, like right around, around this, strike over here. We're like between 480, 482. Okay. So that's kind of the takeaway from that skew perspective. What we did was we looked at it from this level, right, to see like, okay, the skew to what is it, to the downside, to the upside. But when we click on it, we could get another visual of going through all the strikes to see what does it look like. How is it, is it flat? Is it steep? Does it flatten out? It looks like it flattens out as we go higher. It's going down, but starts to slow down, flatten out. To the downside, it's still steep, going higher and higher. And we also see how it changed from one day to the next. All right, so we're right up at 9:30. If there are no questions.
Nothing's popped up, D. Great job.
Okay.
We have the weekend after this, so we won't see everyone till Monday. Have a safe trading day, everyone. Thanks, D.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day. Have a great weekend.